All right, current yield and dividend yield on bonds and stocks we're going to talk about here today on the whiteboard, though, because last time I did this, I did it in my car. And some folks are like me. They're more visually, they learn better visually, so I wanted to put it on the whiteboard as a special request. I tell you, that's why YouTube's such a godsend for me, because I'm a very visual learner, and things that I've read about or listened to until I actually see some guy doing it, I'm like, I don't know. So this will be good. So don't forget to smash the like button. All right, so I've done this video before, but I've done over 1,000 videos, so some certainly got lost in the shuffle. But if it's being redundant, hang in there. You might get a different perspective. Sometimes I watch something 2 or 3 times and it hits me like a ton of bricks, like, oh man. But if it's new to you, I hope you get a lot out of this, because I think it's incredibly important. And then secondly, when you see the simplicity of how this works, you realize, oh, that's it? Yeah, you'll be, I'm telling you, you're gonna be like that. So let's dive into it. All right, so we got a bond. A bond, we'll just say, I don't know, GE for simplicity. I got to think of a new blue chip. I don't even know what the big blue chips are. We'll just say General Electric. When I was growing up, starting the business in the late 90s and early 2000s, GE was always the blue chip that we used. So they want to borrow money, and they said, we're going to, for every $1,000 you lend us, we'll give you 4% in coupon. And then after a certain amount of time, they'll say 5 years, we'll give you your money back. And so GE is operating just like a bank CD. A bank says, we want to raise money so we can loan it out to real estate developers or mortgagers or whatever. And so for every $100,000 certificate of deposit you give us, we'll give you 3%. And then 5 years from now, you come back, collect your $100,000, and that's how it works. I mean, literally from GE's perspective, it's no different than a bank for sure. Now, interesting, in a bank, a CD is actually a liability on the bank's balance sheet. Did you know that? Interesting, huh? And a loan is actually an asset. I remember, when I was looking at my first P&L statement, I was like, why is a CD a liability and a loan is an asset? Because the loan you got coming due, the CD you got to pay out. A CD is like accounts payable, and a loan is accounts receivable. Interesting, huh? Same thing with GE or any company or any government. So they're going to be in the hook to you for $1,000. In the interim, they're going to pay you 4% a year, which is $40 every year. All right, so what we have to do here, and I'm telling you, this is going to seem so elementary, but this is what we got to figure out, your current yield. And your current yield equals what? That's a question. Well, the simplicity. Your current yield equals your coupon that you're getting minus the price. And actually, let me just write that better. I want to do this differently. Let's just do it over here. Actually, let's do this over here. Current yield, always remember this, critically important, equals the coupon over the price. The coupon could be the dividend, exactly, the dividend amount for a stock. So in this case, we've got a $40 coupon, and the price is $1,000. So you take 40 over 1,000 and you get 4%. So the current yield is 4%. That makes sense? All right. So a year goes by. We got that first year of $40 interest. All right. So now we got 4 years left on the bond. Now a year goes by. For some reason, the interest rates went up. Whatever it is. So GE issues another bond. Same credit rating. Everything's the same. Except interest rates have gone up. So now they issue another $1,000 bond, but again for 5-year maturity. But now they're paying 5% as opposed to 4%. What's the current yield here? Well, the current yield here will be 5% because 550 over the price is 5%. So from an investor perspective, which is more valuable to you? You got 4 years to maturity, but you're only getting $160 total income. Or you get 5 years to maturity and you're getting $250 total income. Well, most people say this one is. In fact, I can almost guarantee you all people will say this one is. Because you're getting 20% more income. I mean, that's all there is to it. The reason you own a bond is to get income. I mean, that's why you own a bond to begin with. So now you're getting 20% more income. And so because this is more valuable, even though you're locking up your money for 5 years, even though you're only locking up your money for 4, there's going to be more demand to this bond. And what happens to demand? Demand increases prices, all right? Increases prices, and it drops the yields. But in this case, it won't do anything here because this is issued. What's going to happen is it's going to drop the price here because less demand drops the price. So here I'm buying a $1,000 bond at issue. For this bond to compete with this, the price has to drop, because no one's going to buy a 4% bond when I can get everything else the same at 5% other than 1 year more year of maturity. No one's going to do that. It's just it's not going to happen. So because that, all the demand will be here and little demand will be here, which is going to drop the price to make it equilibrium. So for simplicity, we're going to say the price drops by the same amount as the increase in interest rates. So 5% over 4% is a 20% increase in interest rates, a 20% increase in coupon. So just for simplicity, we're going to say this also drops by 20%. Now it won't, and the reason this won't happen to exactly 20% because it only has 4 years left till mature. So it'll be a little bit, probably 16.6% or something like that. There's a calculation you can use if you want. You can go online and find it. I'm not going to do that. But anyway, just for simplicity, this has 20% more of interest than that does. We're going to say then this will drop by the same price, and I'll show you why. Because what's the yield now? What's the current yield now on this guy? All right, so we got coupon, still 40, but the price is now 800. All right, so the price has dropped. The coupon is still the same because the coupon will always be the same. So the current yield now is 5%. So we have a current yield now of 5%, which happens to be the exact current yield as this, because this was issued at $1,000, and you're getting $50 a coupon of interest, which means the current yield is 5%. So now we have equilibrium. We have a 5% coupon here, a 5% current yield and coupon here, and a 5% current yield there. And the only reason we have a 5% current yield here is because the price dropped. That makes sense? So now that's exactly what happens. All right, so now let me erase this real quick, because I'm going to show you what's going to happen going forward. Because again, this is pretty critical to understand, because this is where a lot of people think there's capital gain to be made in bonds. There's just not. I mean, the only thing that could happen in a bond is you could lose your money because the company goes bankrupt, but you're not going to have any capital gain. I'm going to show you why. All right, so I hear that all the time. I get appreciation, you know. All right, so let's show you how this works. All right, so now we got a 5% current yield. Let's do a different color. Let's do blue. All right, so now we got 5% current yield, and we got a price of $800. All right, so we got price. Let's tell you what. Let's do this. We got price of $800 down here, and we got current yield of 5%. Why is that again? Because we get $40 off the price, which gives us the current yield. Does that make sense? So what happens to price now? We got 4 years for the bond matures. Well, the price is going to go up to 1,000 because it's always going to mature at 1,000. Get a different color. So the price is going to go to 1,000. I mean, there's no other way around that. No one is going to buy a bond, or no one's going to sell you a bond with 1 day left to maturity for $900. When turn around, you could buy it, you could sell it, you're going to issue it back to GE at $1,000. No one's going to do that. No one's going to say, I'm going to sell you a bond for $900. If I just held it for 1 extra day, I get $1,000 for it. No one does that. So we know for a fact that the price will be at $1,000 on the day of maturity. And so what happens is, unless GE goes bankrupt, the price will increase. We'll just say, $875. I don't know. We'll say $950 and $1,000 in the last year. $950. So we know the price is going to increase the closer to maturity you get. Because as long as GE stays solvent, that $800 the bond that's trading now at $800 will mature at $1,000. Now, a lot of people think that's a 20% capital appreciation. It's just, you can't look at it like that. What happens is this current yield is already factored into the appreciation. Let me tell you what I'm talking about. So now in year 3, all right, so the first year the bond paid $40, we bought it for $1,000. The next year the bond dropped to $800. But we still got our $40. The next year the bond went to $875 because it goes up as we get closer to maturity, but we're still getting $40 for that. So now what's our current yield there? Well, it'll be lower than what it was before because we take 40 divided into 875. Our current yield is 4.57. So now we got a current yield of 4.57 because 40 divided by 875. All right, so now what's our yield here? 40 goes into 950. is 4.2%. So now our current yield is 4.2. 4.57, 4.2%. Because 40 goes into 950, that's 4.2%. And we end up with a current yield of 4% because that's what the issue price was. So the current yields go down as the prices go up. Price yields. And so when people say I'm getting some capital appreciation, you're not, I mean, you are, but it's all factored into your current yield, which is going to be the exact equivalent of the other outstanding bonds that are out there on the market, interest rates higher or lower. It just doesn't matter. And again, we're not factoring the fact this only has 1 year less of maturity than the bond that was issued at 5%. But that's how it works. Your price will go up if it's a discount bond. Discount means it's trading below par. Your price will continue to go up the closer to par you get. But the same when that happens, your current yield will go down. There's just no two ways around that. So don't sit there and say, I'm getting $40 a pop plus I'm going to get capital appreciation. Or I should say I'm getting 5% current yield plus I could have $200 of capital appreciation. No, the capital appreciation, so to speak, is already factored into the current yield because the current yield is based on what? Current yield is price, is coupon divided by price. I hope that makes sense. It's a big flipping deal, man, and a lot of people don't get that. So, oh, there it is. Current yield is coupon, or in this case coupon. It could be dividend. And so that's how it works. You know for a fact at the end of the day, the bond is going to be matured for $1,000. You're only going to get, as long as the bond doesn't go bankrupt, the interest rate that it was paying at that time. You're not getting any more. You're not getting any less. You could get less if the bond was bankrupt, but that's it. That's the thing about bonds. I just don't think people get. Let's talk about stocks real quick. It's pretty much the same concept. But I hear this a lot too, like, oh, I'm getting a dividend yield of 8%. Oh, I'm like, really? All right, so let's look at stocks real fast. Is that a good thing? I don't know. All right, so we're going to have, I don't know, we're going to just say stock Microsoft. I don't know. We'll say it's trading at $50 a share. Got to make this drier. Hold on just a second, my friends. All right, there we go. Nice and dry. $50 a share, and it pays a dividend of $2 per share. So again, yield, in this case dividend yield, is dividend divided by share price. So in this case, your dividend yield equals $2 over 50. Was that 4%? 2 divided by 50, yeah, 4%. So your dividend yield in this case is 4%. I have no idea what the numbers are. I can always guarantee it's not 4%. All right. The S&P 500 is paying about 2.3% dividend yield. All right, so the S&P 500 is paying 2.3% dividend yield. So the first thing I'd say is, why is Microsoft, and again, look, I don't know what Microsoft's yield, I don't know. I'm just using this for example. Why is it paying nearly double the dividend as the S&P 500? The first thing it would tell me is because the price is way down. And let me show you what I'm talking about. So now it's at 50. Let's say the price goes to 40. All right, so again, dividend yield is price, or dividend, $2 over 40. Now what's our dividend yield? Is that 8%? Right? We have 2 divided by 40, or 5%. Now our dividend yield is 5%. Huh. Does that make it more attractive or less? I don't know. All I know is the dividend yield goes up because the price goes down. That's what happens. And I think people miss this. Like, oh, I'm getting a 12% dividend yield. I'm like, or that's great, but why are you getting such a high yield? And the only one reason for that is the price has dropped significantly. And then you're thinking, why did the price drop significantly? All right, now here's where the value people, the Ben Grahams and whatnot, and I mean, there's so much research on this. Everybody knows about value tilt, so it's not really a tilt anymore. No, it used to, see, that's the thing about these factor investing. They used to have these things called anomalies, and dogs the Dow, I mean, just value investing, small cap stuff. they're anomalies only until they're not, if that makes sense. I mean, they're anomalies that that you might know more than other people, and that way you can maybe take advantage of the markets. But value investing is no longer an anomaly. The reason value investing works better, presumably, is because it's more risky. I mean, there's a reason why it went from 50 to 40. I mean, that's a what's that? That's a 20% decline in the price. Why? Now, what happened with a company like GE? Because a lot of people are thinking, because they're worried about continuing to pay that dividend. So now, let's go back to this. I'll tell you what I'm talking about. So now we got a $40 stock, right, with a 5% dividend yield. Because now we're going to say this is 40. So the price went down to 40. Now there's a reason for that price dropping so much. I don't know why. The price is 40 a share. So we take our dividend, divide by 40, we got 5% dividend yield. S&P 500 is still at 2.3%. So now this dividend this stock is paying twice as much as the S&P 500. And the reason for that is because the price went down. Now maybe the price went down. That's exactly what happened to GE. Now, so you're thinking, man, I can get 5% dividend. That's a bar. That's a buy. It's a bargain. Maybe the price went down because they're getting ready to slash the dividend to $1 a share. And if they do that, what happens now? We got $1 over 40, which makes our yield, our dividend yield, 2.5%. So it's gone in half. You see what I'm saying? So there is a reason for the stock to be paying a higher dividend yield. And the first reason is the simple fact that the price went down. And the price went down because maybe they're slashing their dividend. I mean, it could be a number of reasons, my friends. Maybe they don't have enough cash flow to pay the dividend. I mean, just a huge amount of reasons for the price to go down. And that is why value stocks will probably continue to outperform, because when all is said and done, there is more risk here than there would be for buying a company that is not having significant high dividend payouts. The reason isn't dividend payouts, dividend yields. The reason the dividend yield is so important to understand from a value perspective is because it means the price of the stock has been beaten down. But just because it's been beaten down doesn't mean it's going up. I mean, it could easily could be driven off the S&P 500, which will kill the stock. A number of things to do that, but the facts are you're buying a low dividend or high dividend yield. That means a low price stock means there's more risk, because there's more risk because the company could go bankrupt or could actually get rid of the dividend outright. I mean, there's numerous reasons for that. And so when you're taking on more risk, what should be the reward? More or less reward for the people who take on more risk? Well, more reward theoretically, which inherently makes sense. So the reason there's a value, it still isn't because there's anything that, ooh, we're so much smarter. It's because there's more risk. There's more risk because the value simply says the price has dropped, which is why the dividends are higher. What's a value stock? A value stock is one that pays a higher dividend. When it pays a higher dividend, that doesn't mean it pays a higher cash amount on its dividend. It means it has a higher dividend yield than the S&P 500. That makes a value stock. A lower price to earnings, a higher dividend yield. All right, and then they'll say a low price to book too. That's the three factors on a value stock versus a growth. So people are like, oh, I'm getting this at value. Yes, you are getting a value, but you're getting a value for a reason. Your reason, because the price has dropped, the dividend yield has increased, the price has dropped, the PE ratio has dropped as well, which means what was usually before a $15 PE ratio is now a $10 PE ratio. Price to earnings being low, dividend yields being high. Right? You get those two things, and price to book being low too, but I'm not going to talk about price to book. PE ratios being low, dividend yield be high, that is a value stock. In of itself, that does not mean you're going to buy that stock and you're getting over on the rest of the market who doesn't know what's going on. It just means there is more risk into the future prospects of that stock. And it might come to fruition, it might not. I don't know. But you think back to Apple in 1997, or 97 or 98, maybe 98. When Steve Jobs went with hat in hand to Bill Gates to get some capital infusion. Apple was trading at like $7 a share back then or something like that. Was that a value stock? Well, it didn't pay a dividend, so we can't say. I don't know what the PE ratio was, but at the end of the day, that was a risky stock. Now, it happened to reward people dramatically for sure, but it was risk inherent in Apple back then. I mean, you just can't get around that. People who took the risk made out handsomely. But a lot of people said, yeah, that's too risky for me. I'm not willing to take a chance on throwing, even though the price per share is only $7 a pop. You know, if I buy 100 shares, that's still, whatever that is, $700. I don't want 100 shares, $700 to go by the wayside because of what could happen. And that's the value tilt. What I think a lot of people underlook is the value tilt on high dividend yield stocks versus low PEs. Now, a lot of people say, well, maybe it's a high dividend yield because it pays so much more of its income out to the shareholders as a dividend. And that leads to another concern, like why are they paying so much of a dividend? Now, it might be utility, which is heavily regulated, so you shouldn't see a lot of volatility. But if it's just regular Joe Schmo company is paying a high dividend, why? Where's that money coming from? I did a video a long time ago on a company, I forgot what it's called, but its dividend, it was taking on debt like crazy in order to finance its dividend. That's bad, man. I don't care what anybody says. I told this guy I was dealing with his sister, I said, man, I think she should sell the stock. And I have no clue what it's done since, but this is the only stock she had. I said, if this thing goes kaput or if the dividend is cut, she's going to be in a world of hurt. And so if you're taking on debt in order to finance the dividend, that's not good, man. That gravy train cannot, that'd be like taking on debt to pay off your credit card bills. At some point, that stuff is going to stop. And bankruptcy is your option, for sure. No other way around that. Now, if it's high dividend because of increasing operating earnings and making money, you think that has been reflected in the price? Maybe it hasn't. Maybe you are smarter than the rest of everybody else. And you say, hey, this company continues to make high profits, high cash flow, high operating revenue, and the dividend is reflecting that. I'm going to buy that puppy. Well, you might be in front of that. Hard to imagine you can find a stock that has high dividends, all right, with a high dividend yield, high cash flow to afford those dividends, and a low price to earnings that no one else is. Hard to find that without. I mean, I can almost assure you, you're going to be, you'll have a hard time swimming against that stream because everyone else is out there to look at the same thing. Everybody wants a stock that pays high dividends, good cash flow, not taking on a lot of debt with a low PE. That's what we're all. I mean, that's the elixir. That's what we're all looking for. And ain't many out there like that. So I hope this helps. A tutorial on bond yields and dividend yields. Remember, it's simple. The price of the stock or the bond divided by the current yield or the current coupon or the current, whatever, in this case, the dividend that is paying. The dividend, not the, so you're trying to find out what is it paying right now, $1 a share, $40 for the bond, $1 a share for the dividend. Divide that by the price and they're going to get your dividend yield or your current yield. Nothing else matters. That's how it works. As simple as can be. Don't be too swayed by the value tilt because there's a reason for that. All right, we'll see you next time.